Have you ever considered how taxes can impact the inheritance that you want to leave behind? What if the gift you actually want to leave behind ends up being a burden to your children instead, forcing them to sell precious belongings or to use their own savings to cover taxes on your estate? Unfortunately, we can see this happen with poor planning. In fact, I'll talk about a tax bomb that many Canadians are leaving in their estate that could impact them tremendously, causing hundreds of thousands of dollars in tax liability. Hey, I'm Hervin Pesa. I'm a practicing financial planner here in Calgary. This video will help you realize that the CRA or Ottawa doesn't need to be the biggest beneficiary of your estate. The primary residence exemption is just one of the many estate planning tools that you can learn about, so that you can leave a larger and more meaningful legacy for your family and the people that you care the most about. I'll break this video down into 6 sections. Check the timestamps if you're curious about a specific question. Section 1. How does gifting your primary residence in the primary residence exemption compare to the other inheritance items like RRSP, investment accounts, and rental properties and raw land? Before diving into the details, let's understand why the primary residence exemption stands out as a powerful tool in estate planning. It's unique because it allows you to pass the value of your home to your heirs, ensuring that they receive the full benefit of its appreciation tax-free. Keep it down so that they don't take it away from us. This is a stark comparison to other common estate assets that are subject to significant taxes. Let's compare how that's different if you left a non-registered or a margin account, a rental property, and an RRSP. First, the non-registered investments. Leaving $1 million portfolio of non-registered investments or margin investments to your heirs can lead to a significant tax liability. The gains on these investments are subject to capital gains taxation, reducing what you actually leave for your children or for your family. For example, if your investments have appreciated by $500,000 based on the 2024 inclusion rates, this is how this will break down. The first $250,000 will still attract the original 50% inclusion. So $125,000 is added to your taxable income when you passed. The secondary inclusion threshold from $250,001 to $500,000 will fall under the new 2/3 inclusion rate. That's $166,667. The total additional income to your estate is $291,667. Because that's all added to your total income the year you pass, that puts you or your estate in a significantly higher tax bracket in the final year. Just as a side note, if that happened last year, only half, so there's no secondary threshold, 50% of the gains will be added to the final taxable income year. This will diminish their estate. This will diminish what your heirs get significantly. Then there's rental properties or raw land. This will work just like the non-registered investments, that if you leave rentals to your kids, only the gain is taxable. That's then added to the taxable income, increasing the taxes that you'll pay in your estate during the final year. The only difference is that you will have a larger selling cost to go against your total gain. So if you're claiming CCA, some of you might not even know what that is. That's the tax equivalent to depreciation in your rental properties. There's also a chance that that needs to be recaptured or paid back. That CCA recapture acts like a regular income in a sense that there is no inclusion rate. It's all notional income added back to the taxable income that year. I will exclude the recapture in our example. Let's just say that it's a mortgage-free $1 million rental unit and you paid $500,000 for it. You will likely pay more than $35,000 in selling costs or liquidation costs. There's the commission that you pay to the realtor, there are legal fees, and there's also transfer taxes depending on the province that you're in. So for our example, that's actually a conservative cost to liquidate. RRSPs is a different animal altogether because it's treated as if it's never been taxed. RRSPs will pose the largest threat to your taxes for your estate. RRSPs are common retirement savings vehicles, but they also come with significant tax implications. This is the largest tax bomb that most Canadian retirees fail to understand. When you pass away, because the RRSP has never been taxed before, the full amount is added to your income in the year of death. This pushes you into likely the highest tax bracket. If you had $1 million RRSP, this means that up to 50% of your RRSP could be lost to taxes. Can you imagine gifting the house to one child that's $1 million, but then the other kid gets $1 million RRSP, but after they pay taxes on it, it's actually just $500,000. That is a painful mistake. Again, when you look at the primary residence, in contrast to all of this, the exemption allows you to transfer the full value of your home, minus the selling cost, because that still needs to be done, as long as it qualifies as your principal residence. This can be one of the most efficient ways to preserve wealth within your family. So if your home appreciated by $500,000, maybe more if you're in Vancouver, you're in Toronto, even in Calgary right now, that entire amount, it doesn't matter if it's $500,000 or $5 million in theory, that can be passed on to your heirs without any tax liability. This is why this is a powerful estate planning tool. Hey, quick commercial break. I don't know if you've noticed, but there's a link right here showing you how you can get access to this retirement readiness checklist. I call it a retirement audit. It's free. Get your copy and work through it so that you can get more clarity and just get an understanding of how close you are to being ready to retire. Back to the video. So how do you qualify for the primary residence exemption? Let's first understand the definition. The primary residence exemption allows Canadians to sell their primary home without paying any capital gains on the profit. This means that any increase in the value of your home over the years is not subject to tax. It bears repeating. It's worth repeating. So what is the criteria? To qualify, the property must be your principal residence, principal place of residence. Most people assume that this means it has to be the home where you live in most of the time. However, there's actually no quantification of how long you have to stay in the property. So that's not true. It can even be an out-of-country residence. Here are the key criteria for a home to qualify as your primary residence. 1, your ownership. You or a family member must own the property. The residence itself must ordinarily be inhabited by you, your spouse, or your children at some point during the year. There's no set dates. There's no set periods of time. Of course, the designation. This is not automatic. You must designate the property as your primary residence when you file the return. Each family unit can only designate one property per year. So your spouse can't have a separate primary residence from you. It can be used on various different types of structures. The property can include a house, a condo, apartments, cottages, mobile homes, or even a houseboat as long as it meets the residency and ownership criteria. However, why would you use it on a houseboat if those typically go down in value, or trailers, the same thing? So you have to look at this as a case by case. Now, additionally, there are certain restrictions that apply if the property has been used to produce rental or business income. So if you rent out a portion of your home, you can still potentially qualify for the exemption, but you may need to apportion that exemption based on the percentage of the property that actually got used as your personal use, personal residence, versus the business or the rental purposes. Homes in a large land and those that are attached to farming or business also have specific nuance to it. I'll have to tackle that in a separate video because that's quite complicated. Now that you know what the primary residence exemption is and how you qualify for it, let's see how else it can be used for estate planning. Section 3. What are the primary benefits of the primary residence exemption in estate planning? Of course, we've already talked about the tax-free gains. This is the most significant benefit of the primary residence exemption because it doesn't matter how much gain there is. If you bought a home for $300,000 and now it's selling for $3 million, as long as you meet all the other criteria, that will be tax-free as a transfer to your family. Now, this is significant when increasing or enhancing your financial security in retirement. It's not just the value of your estate, because if you need access to the value of your home, you can get that tax-free. Of course, there's the advantage of this wealth transfer. You pretty much get to give the value of your home intact to your kids. That tax-free status means more money can be passed down to your beneficiaries. It's just a massive way to increase the value of what you leave behind. So let's dive deeper and see how this actually applies in real life. Section 4, using the primary residence as a strategic tool to put your estate planning all together. 1, minimizing the tax burden is important. Using the primary residence exemption strategically can minimize the overall tax burden in your estate if you have other assets. This ensures that your heirs receive the maximum benefit from your estate. For instance, if your estate includes other taxable investments, earlier I did a comparison of RRSPs and non-registered accounts, but what if you actually had a bunch of those all together? So taxable investments and other properties. Utilizing the primary residence exemption can actually help you offset some of those potential taxes when you're equalizing it to your children. So let's talk about equalizing the inheritances. This exemption can also be used to equalize your inheritance to multiple beneficiaries. Selling your primary residence tax-free, right? Like, so imagine this is happening now before they get it. You get this liquid asset, you get the liquid funds after selling. That is so much easier to balance and to distribute to your children. So for example, if one child inherits the family business, the proceeds from the home can then be distributed to the other children. But of course, you need to be mindful of the division that is fair to you and your family. It's not always equal. So let's talk about some real life examples now. Scenario 1, selling your high value home. So just imagine you own a home in a high demand area like Toronto, Vancouver, Calgary, and it's just gone up. It's just skyrocketed in value. By selling this home, you can take advantage of the primary residence exemption and save yourself hundreds of thousands of dollars in taxes. This tax savings can then be translated into more money for you in your retirement. Scenario 2, what if you just want to downsize? In scenario 1, we wanted to appreciate or we wanted to take advantage of the value. In scenario 2, let's just look at downsizing. If you're downsizing, the sale of your primary residence can provide a tax-free lump sum that can then be reinvested to boost your own retirement lifestyle. So if you're selling a large family home and you're purchasing a smaller one, a more manageable property, whatever funds you free up, you can start sprinkling to your family, or you can put that in your own pocket and live a greater life in retirement. Scenario 3, transferring property within the family. Oftentimes, this is the family cottage. Transferring a property to anyone, even family members, is a taxable event, even if you receive no cash considerations. But if done properly, you can transfer the family home, whatever you declare as your primary residence, which actually can be the cottage. When you're utilizing this exemption, you can keep that cottage in the family without the kids having to incur the tax penalty or the tax liability for it. So if you're gifting that as a part of your broader estate plan, you can do this while you're still alive. When people look at estate planning, they have this misconception that it's all about after. A proper estate plan is a multi-generational and multi-year process. If you're hoping to preserve as much of your wealth, whatever you've worked hard for the last 20, 30 years, and you want to give the most to the next generation, that will take some time. And you have to make decisions to give now, give some of the value now, transfer some of the value now, or you might even need to freeze some of your business value when you're transferring it to the next generation. I know this is about the primary home, but I just want to take a second to really nail down that point. Estate planning, when done properly, happens years, maybe even decades, before people are reading your last will and testament. So you don't have to use the primary residence exemption when you pass. So let's look at implementing and looking at the strategies around the primary residence exemption, what you need to watch out for. The first thing that I'll tell you when you're trying to implement all of this, especially when there's tens or hundreds of thousands of dollars of tax mitigation at stake, consult a professional. Consulting with financial and legal advisors is crucial to make the most of your primary residence exemption. They can help you navigate the complexities of tax and estate law when you're looking at your overall picture so that you can leverage what you've built more effectively. The second thing you need to make sure you're careful of is documentation. Proper documentation and designation is essential when you're trying to take advantage of the primary residence exemption. Make sure your home that you're designating as your primary residence on your tax return is actually the one that you should be using depending on the benefit. Again, your professionals should help you decide if you have multiple properties, should help you decide which one, if you have multiple units that qualify. And you could do that by keeping thorough records of any changes that you've made in your residency over the years. Even renovations or improvements that can have an impact on the value of your property, but also if you end up not qualifying for this exemption, it can help increase the cost basis of whatever you're selling. So that documentation is important. Number 3 is make sure that you're looking through a regular review cadence. Regularly review and update your estate plan to reflect any changes in your personal circumstances, and always ask your accountant or your financial planner, hint, hint, for changes in the tax law, for changes in your estate options, for shifts in the value of your home, if that's an important item to discuss. So before I wrap up, the primary residence exemption is so powerful, and I hope that I did a good job highlighting that. I was afraid that some of this could get repetitive, but again, I just want you to see it in multiple scenarios and how it can apply, and just getting a clear understanding of it so that you can just maximize the value of your estate and ensure that more of your wealth is passed to your heirs. By selling your primary residence while you're alive, you can significantly enhance your financial security. But moreover, it's a great tool to leave a substantial legacy. So let me leave you with some calls to action. Consider how the primary residence exemption fits into your overall estate plan. I'm not saying you should chase after this, but you should be aware of how this domino tips other portions of your financial picture. Now, consult with your own advisor to make the most out of these benefits, and take the time to create a proper financial plan. Be strategic about this. There's too much at stake. Selfish ask, share your thoughts and questions in the comments below. Have you ever considered your primary residence as an actual estate tool? For more insights on retirement estate planning, check out these videos right here. Thanks for watching. Bye! Thanks for watching. God bless you.